Okay, good day, everyone. My name is Tracy Wong Harris, Deputy Secretary General of the Hong Kong Green Finance Association. Thank you for joining today's HKGFA Green and Sustainable Banking webinar on why green and sustainable banking is such a critical topic, and our experts will be sharing ideas on how to address some of these key issues. Today's webinar is completely oversubscribed. I want to share a special thank you to our supporting organization, the Hong Kong Monetary Authority, the Hong Kong Association of Bank, the Treasury Market Association. As someone transitions from traditional investment banking to now 100% in driving green finance, the topic of green and sustainable banking is especially close to my heart, and I hope that you are as excited as I am. Some housekeeping before I introduce our first presenter. The webinar is being recorded and is live on YouTube. During the webinar, we will have a few polling questions, which I ask your active participations, and we will be sharing the result live with you. Lastly, I encourage you all to take this opportunity to ask questions by using the Q&A button at the bottom of your screen on Zoom, or the live chat box if you are on YouTube. We will try to answer questions at the end of the panel discussions. Without further ado, let me introduce our first speaker, Mr. Jonathan Ju, our very own HKGFA Vice President, Green and Sustainable Banking Working Group Co-Chair, HSBC Director on Infrastructure and Real Estate Group, Global Banking APAC. I want to take this opportunity to officially congratulate Jonathan on his new addition role as the global head of the newly created ESG Solution Unit in HSBC. This is a great news for Hong Kong and the region, demonstrating the importance of ESG and sustainable financing. So now over to you, Jonathan.
Tracy, thank you very much for those very kind opening remarks. It is indeed a great pleasure to be with everybody today to talk about this hugely important topic. And you started with a number of questions, Tracy, so let me try and tackle the big one first. Why? Why are we talking about green and sustainable banking? Well, my answer to that is because a green and sustainable banking system is just a fundamental foundation or critical enabler of what we might call sustainable development. And I'd just like to sort of try and unpack that topic a little bit as we get into the presentation here. I think we can all as individuals recognize the concepts of development and progress in terms of creating wealth for ourselves, creating a healthy system, and also creating, in a sense, that broad and elusive concept of happiness. But when we look at this concept of sustainable or sustainability, this is a much more complex topic. And the fact that we're using the word sustainable, as with many things in language, it sort of implies that perhaps we are doing something at the moment that's not sustainable, and that we therefore do need to change. And a concept of sustainability and sustainable development that's often been used is this quote here from a UN report from the 1980s of sustainable development being this concept of meeting today's needs without jeopardizing opportunities for future generations. And we'll come back and talk a little bit about what future generations might be saying and thinking about this at this point of time, recognizing there is a threat. There is a threat to opportunities for future generations. Another way to look at this concept is of sustainability or sustainable development. A definition here from a very well-known economist, Jeffrey Sachs, who broke it down into three components. The first, economic development, the idea of creating wealth, but that we need to do that in a fair and inclusive manner. And critically, we need to do that in a manner that's environmentally sustainable, or to put that into sort of simpler language, to sort of create progress, but without destroying the environment upon which that depends, or we depend as a species, for the air we breathe and the water we drink and the the food we eat. And if we look a little bit about sort of historically for a moment as to how society has performed against these three elements, the first here is economic progress as measured by GDP. And this is an extraordinary graph here that depicts perhaps success. It does, I think, give rise to some important questions, a sort of why did it stay flat for so long? Why did it turn up and where's it going? But also questions about, well, GDP, are we sure this is a good measure? And maybe this graph and this picture of success is just a little bit too good to be true. And we'll talk about that. But turning to the second leg, there's another element to look at. And if we just for a moment use the concept of GDP and look here about how this extraordinary economic wealth in the sort of post-industrialized period, we can see the inequality. And if we look at the sort of ratio of GDP per capita between the richer regions and the poorer regions pre-industrialization, and maybe that ratio was 2 or 3 to 1, and then look at that ratio post-industrialization, the light gray bars there, we see that that's exploded to about 5 or 10 times on that ratio. So the benefits and the wealth created through the industrial process has been hugely unequally distributed, and that's creating major tensions in society for society today. And another important factor, of course, is sort of thinking about GDP and thinking about some of the other impacts that may not be captured there, and think about that moment when production that we're measuring in GDP is converted to consumption, and something extraordinary happens as we depict here. This is all the packaging of what we produce that's ripped off, left lying around, and we know this is creating a huge problem for us. This is the plastic and the waste that gets into our ocean and water systems and then starts to have huge adverse impacts on our food system and hence on us. And whilst you might think that this is a picture of some poor country, I'm afraid to tell people this is a very rich city. It's Hong Kong. This is Hairpin Beach, just outside Stanley, and a picture taken the morning after a moon festival. So this is us. This is what we do. Now, waste is not the only adverse consequence of this sort of economic miracle that we've been through. We can also see how our activities have, caused us to put toxic substances into the atmosphere, chemicals into our water sources, and our use of the land area of our planet has destroyed and is destroying the very biodiversity that stabilizes our food supply chains. And of course, at the top there, you can see this concern around greenhouse gases and climate change, which is a very complex topic. But the one point I wanted to make about climate change is that it's actually based on physics and robust physics theories, and the concept that the planetary temperature is set when the energy absorbed by our planet from our external energy source, the sun, balances with the energy that as a warm body or a black body, our planet radiates back into space. And there's a formula for that. You don't need to learn the formula, but just understand perhaps that there is a formula. And actually I could give you all of the constants in this formula, and you could calculate the temperature of our planet in this sort of bare rock scenario, and it would come out to be about -20 degrees centigrade. But of course, we're very fortunate, and we're all here today because actually we do have an atmosphere around our planet that naturally contains greenhouse gases, carbon dioxide being one of those, and we benefit from this natural carbon cycle that puts CO2 into the atmosphere and it's exchanged by the minute between the three main reservoirs and resources of CO2. And it's been like this for a long time. This picture shows how the correlation between CO2 and concentrations of CO2 in the atmosphere and planetary temperatures have moved very much in sync, and they're correlated. Don't confuse correlation with cause and effect, but you can see the correlation over 500,000 years as our planet has moved into and out of ice ages, with concentrations driving temperature rises driving increased CO2, and the shifts between ice age and out of ice age driven actually by planetary movements, and the Earth over time through its sort of natural wobble in our planetary cycle, the so-called Milankovitch cycles, just moving slightly closer to and further away from the sun, and that's what's driven us through these natural cycles. But then if you look on the right-hand side of the picture here, you can see how suddenly human activity has come in and perturbed the cycle, and that CO2 level has now shot through the roof. Carbon dioxide is one of the key greenhouse gases or impacts, that the anthropogenic activity that's had an impact, but it's not the only one. And the message here is, just remember, modeling Earth science is very, very complex indeed. But all of these gases that we put into our atmosphere have an impact on the amount of energy that our atmosphere absorbs, and therefore that is retained, that would otherwise have been radiated into space, and hence the planetary temperature is driven higher. And since the Industrial Revolution, the measured planetary temperature increases, and these are figures from the IPCC, have risen by more than 1 degree centigrade. And what's that done to us? Well, here in Hong Kong, here's Hato and here's Mangkut. Warmer planets driving a higher frequency of higher impact storms, damaging what we build and often stopping us going to our places of work. So huge economic impact. Temperature also impacting other areas of the natural environment. Now these fishes here, they're not too sensitive to temperature themselves, but they live on reefs that are very sensitive. And sea level temperatures have now risen to a certain level, and the expected future rise is such that marine biologists now predict that the entire global species of coral will have disappeared within 30 years. And with that, the livelihoods of 1 billion people who depend upon fish and seafood from the sea will be extinguished. Huge impacts of temperature change. And then how could we talk today without mentioning this depiction of COVID and science today telling us very clearly that the likelihood of major pandemics significantly increases with temperature level increases. So it's a good thing, I would suggest, that responsible governments from around the world got together back in 2015 in Paris and agreed to try and maintain global temperature rises to be no more than 2 degrees centigrade above the pre-industrial revolution level. A global accord. We're already at 1. We don't want to go above 2. And you might say, why 2? What's the magic with 2? Well, to answer that, perhaps think of 3. And what does 3 mean? Well, a couple of statistics. Firstly, at 3 degrees centigrade, scientists project that all of our arable land where we grow our crops and all of our rainforests that house today our diversity would be turned into deserts. Massive impact on us. And furthermore, at 3 degrees centigrade, eventually all of the ice sheets, Antarctic and Arctic, would melt. Pour that water into the sea, sea levels would rise by about 50 to 70 meters globally. Now imagine the impact of that on the valuation of your Hong Kong real estate portfolios. This is real. And if you go to the Hong Kong Observatory website, which you now are being asked to do by the Monetary Authority, you will see there you're being asked to look at what is the impact of 4 degrees C scenarios. Something to think about there, I would suggest. So in terms of thinking about solutions before we get too concerned about failure, what do we need to look at and what do we need to do to actually address this? Well, from the little bit of scientific introduction, I think it's pretty obvious we need to address CO2 concentrations. This graph here, the Keeling curve, shows concentrations today at about 417 parts per million. Now, to put that number in context, the consensus of science says, and from the IPCC and others, that if we want a 66% chance of temperatures staying below 2 degrees C, we have to turn this curve flat before the concentration gets to 450 parts per million. Now, you can probably by eye judge the slope on this curve. It's increasing at about 2 or maybe 2.5 parts per million per annum, and therefore on our current trajectory we're going to be at 450 within somewhere between a decade and 15 years. A decade and 15 years. So in a sense the solution then becomes evident, and this is again going back to the IPCC. These are the carbon pathways. This is the radical, dramatic, traumatic reduction in CO2 emissions we need to go through if we're to stay below that 450 level. So I think you can immediately see, and this is a conversation and a webinar principally about risk, we have two big issues here. We have the risks of allowing temperatures to rise, and what does that mean? And we have the risks of how do we actually manage through this dramatic transition set here. So you'll hear later from Joe talking about, and the GARP team talking about risks, these concepts of physical risk and the transition risk. But sticking with the solutions for the moment, just look at where these greenhouse gases come from. This is the sectorial breakdown. A lot of it driven by the usage of fossil fuels for electric power and in industry, but also from our agricultural systems. All of these need to come to somewhere close to zero. And a question I'd put to all of the bankers listening in is, do you have a client who is either not directly or indirectly involved in these sectors? Because if you don't, and none of your clients are affected, you can switch off now and you can go and watch something else. But if you do, this is your business. Another way of looking at this challenge is, this is something called the Kaya identity. It looks at carbon generated as a function of these four factors here. We've seen in the first 6 months of this year how a reduction, or in a sense a forced recession through economic lockdown, has reduced carbon emissions by impacting factor 2 here. GDP per head of population has declined. That will drive carbon emissions down. But that's not really the ideal way in which we want to transition by shutting down our economy, because clearly that is not the creation of wealth path. That solutions really lie, I would suggest, in factors 3 and 4, which is how do we make our economy more energy efficient, and how do we take the carbon content out of our energy? And the solution to that, or a key component of the solution to that, is of course money and investment. We need massive investment in our economy to drive this transition. And this is investment that's going to be made by our clients. $100 trillion over the next 15 years, and about 70%, according to many leading economists like Nick Stern, who's visited us here in Hong Kong, about 70% of this is going to have to happen in growing Asia. Now, the good news, perhaps, is that the capital's out there. We know our systems are awash with capital. The measure of money managed, or assets under management, by UNPRI signatories, 2,500 of them, and more than over $100 trillion of AUM as we sit here today. $100 trillion, how do we connect that at 8 trillion, whatever, 1,500 divided by 15, 8 trillion a year? Who does that? Well, they're called bankers, because we connect those pools of capital with our clients who are making these investments. This is our opportunity as bankers. And what might be driving this and what might be starting to happen? Capital is shifting. Extraordinarily, in the first 3 months of this year, if we look at, here's just one measure, looking at the MSCI ESG index. And if we take the performance of the stocks of the leaders, the 100 leaders, and compare those against the stocks of the 100 laggards, we have a 17% outperformance by the ESG leaders. Think about that for your own personal portfolios and the portfolios of your clients that you help manage. In other areas, we've seen in labeled products, huge growth, green bonds. This is corporates tapping into this. 2020 year to date, notwithstanding all the restrictions or distractions of COVID, we are already about 30% ahead of last year's run rate. It's a similar story in the loans market. We've seen huge growth in the loans market. Annual total about 170 billion of green and sustainability linked loans in 2019. And you can see from the quarterly bars here, it continues to grow. This is happening in our business. And if you think this is happening everywhere but not in Hong Kong, then take a look at this. This is the list of deals, green certificates, green certified trades by HKMA, launched in late 17, early 18. Look at the business they're doing. And it's not just the big guys, it's right across the space. So if your clients and your deals aren't on here, that's an opportunity missed. Coming back to other drivers, of course, we're seeing markets move, and we're also seeing those next generation people demanding that today's leaders make a shift. So there's a huge generational tension arising here. And Greta here, she's a representative in a sense. She's tomorrow's employee, she's tomorrow's consumer, she's tomorrow's investor. This is the concern and the priority that is being given to this space. And if you like your messaging from somebody with more grey hair, well, this gentleman, Mr. Carney, and his comment here that made the front page of The Guardian pretty much says it all. If our clients and we don't work out what to do with climate change, we're going to lose a lot of money. Coming closer to home, in China, back in 2016, China launched a huge program where they made crystal clear the role of the finance industry in supporting the transition to a sustainable future. 7 top-level ministries signing up to this blueprint, and it's extraordinary what's in here, from product development to market infrastructure and so forth. Even closer to home, you know where this is. This is where Frank, who's going to talk to us in a little bit, lives. He's sort of right up the top with his oxygen tank. This, of course, is the Monetary Authority. And the Monetary Authority here has shown tremendous leadership. May last year, here it came. How do we as a system, encouraged and driven by the authority, create this green and sustainable banking system? It's a 3-part or 3-phase approach. The first, and every bank I think on this line now knows or will be involved in, the Common Assessment Framework. And if anybody thinks the questions that you're asked in that questionnaire are easy to answer, I'd suggest you've misunderstood the questions. This is really tough. And we're now moving, with the white paper being announced just last month, into phase 2, with the regulatory expectations now being set out. So there's going to be some real meat and bite to these. So with that, I would sort of summarize by saying, whether you're interested in making more money on your own personal savings, whether you want to help your clients make more money, whether in your lending business you want to do more lending business and avoid losses, or if you simply just don't want to be hit by the sharp and pointy stick of the regulator, then 2 things: think green and think sustainable. And with that, I'm going to pass back to Tracy to take us into the next stage.
Thank you. If that doesn't kick anyone into action, I don't know what does. So thank you, Jonathan, for setting the scene for this webinar, highlighting the key challenges we're all facing under climate change and the important role of finance. So now let's keep the momentum going, and we have our first set of polling questions. So let me launch it. Okay, good. So here we go. I need everyone's active participation. So question 1, which part of the organization do you represent? So this is an easy one. So finance reporting, frontline, risk, corporate social responsibility, other. Question 2, how confident are you in your understanding of ESG sustainability to enable you to meet your own work expectation? 1 being the minimum, not confident at all. 4 being maximum, I'm confident and know where to go for support for areas that I don't know. Now, the final question for this poll will be, how well equipped and prepared do you think your institution is to address risks and seize the opportunity arising from the transition to a better and more robust future? Again, 1 being minimum beginner stage, 4 being the expert, the leader in sustainability and sustainable banking. So let's take 5 seconds more for you to cast your vote. And just to call out, we will only be sharing the aggregate result. So feel free to cast your honest vote, okay? I see the votes are all coming in nicely. Very good. I'll be ending in 3 more seconds. It keeps changing. All right, okay. I'm gonna end the poll now and share the results. All right, let's all take a look. Okay, so I see that from question 1, we have people across different line of the business from the bank, everywhere. Now, question 2, how confident? So we have number 2 and 3, so the middle range of confidence in your understanding of this poll. And lastly, how equipped and prepared you think your institutions. I see the results are also very mixed. Okay, I'm going to share the result, stop sharing. Okay, so, well, thank you all for cast your votes. And now we got to know our audience a little bit better. Clearly, we still have some ways to go. So now let's turn to our next presentation on finding out how to address some of these risks from GAP Risk Institute, our newly on board HKGFA member. Ms. Jo Pasley, Co-President, Ms. Maxine Nelson, PhD Senior Vice President. Over to you both, Jo and Maxine.
Great, thank you very much. Thank you for the opportunity for GARP to speak today. So Jo and I will take you into some more detail about the climate-driven financial risks and how financial firms around the world are managing those risks. So that will fit in nicely, I think, with the results from the poll that showed that there's still quite a lot of knowledge building required in this field. We're going to start by looking at the financial risks that arise from climate change. Now, there's 2 different climate risk perspectives, and it's important to understand which perspective we're talking about. Now, the first perspective is how we impact the climate. For example, we impact the climate through emissions from transport, heating, deforestation, food production. And then the second perspective is how the changing climate impacts us. For example, this train's got stuck in a flood. So when we're looking or trying to understand, when we're talking about the risks from climate, we need to understand which perspective we're looking at the risks from. And then to add more complexity to this, these 2 perspectives are interrelated over long time periods. So the more we impact the climate, the more the climate will change and impact us in turn. Now, corporates should be assessing their risk from both perspectives. They should assess how they affect the climate, because their emissions could not only result in reputational risks for them and liability risks, they're also a proxy for their exposure to transition risks, because companies and industries with high greenhouse gas emissions are more likely to be impacted by a transition to a low carbon world than those with lower greenhouse gas emissions. But corporates should also assess how the climate affects them so they can understand their financial exposure to physical risks. Now, financial institutions are a little bit different to corporates because their own emissions are normally quite low. So whilst they should understand how they affect the climate, the main focus for financial institutions is to understand the impact of transition and physical risk on their counterparties, the corporates they lend to and households they lend to and invest in. So the energy sector is a good example of this. It's a major contributor to greenhouse gas emissions, and its use has increased exponentially since the start of the Industrial Revolution. But if we look at the figure on the right, the climate is also expected to impact the income, the profit, and consequently the returns from the energy sector. So in an environment in which the global temperature has increased by 2 degrees, the returns from the coal industry, for example, it's expected to have no value by 2050, and the oil and gas industry is expected to have nearly no value. On the other hand, the renewable industry is expected to increase in value by more than 150%. So while we're doing our day-to-day lending, our day-to-day investing, we need to keep in mind that there are real financial impacts on the businesses, reinforcing the points that Jonathan made. Now, it's not just industry that's affected. It's not just energy industry, it's all different types of industry. Because while the energy industry emits the most greenhouse gases currently, other sectors are also large emitters. And these industries are also already feeling the impact of climate change, and they're feeling it in different ways depending upon their business model. Some industries are affected by water scarcity, some by deforestation, some by greenhouse gas emissions. So you need to go into detail and understand for each of your counterparties, your customers, how they're being affected by these changes. And these changes, as I've said, are creating financial impacts. And the financial impacts will affect businesses and firms differently depending upon their industry, their geography, their business model. And the physical and transition risks will impact a firm's strategy and therefore its risk management. And they will consequently impact the profit and loss by changes in revenue and expenditure and the corresponding income. They will also impact the balance sheet by altering the value of the assets and liabilities. And they will also therefore impact the ability of firms in the real economy, the corporates, to raise capital and financing, and they'll also affect the cost of raising that financing. And this is why it's key that people in the financial institutions start to understand these risks and how they're impacting the firms they deal with. Now, transition risk arises as the world shifts to a low carbon economy. I'm not going to go over everything in this slide. I've included it for reference for when you look at the slides later. But I will say there are 4 different categories of transition risk. One is policy risk, which arises due to changes in regulation, and the legal risk from climate-related liability. We also have technology risk, which is caused by emerging technologies that will challenge the current ways of manufacturing, energy production, and transport, to name a few areas. We also have market risk that arises from changing supply and demand and changing consumer preferences. And then we also have corresponding reputational risk. On the physical risk side, so the physical risk is the risk that arises from changes in the physical environment. And it's divided into 2 types of risks. Acute risk, which relates to weather events that become more severe or occur more often. For example, more frequent or more severe typhoons. And then we have chronic risk, which relates to longer term changes in the weather, such as rising sea levels or the increase in the average global temperature. Then we'll look at the transport sector for an example of how these risks arise. It faces risks such as policy risk when countries legislate to increase the fuel efficiency of their buses, trucks and cars. And this can increase the cost of operating petrol or diesel powered transport, thereby reducing the revenues and income. Technology advancements can, for example, decrease the value of ships, and this is happening quite rapidly, which affects the viability of their long-term financing. Shipping finance is done over, very long time periods, and the technology is evolving so fast that the value and the efficiency of using ships that are even a decade or so old is now much harder, and it's much harder for them to make sufficient returns to now start repaying their loans. And existing companies can also be affected by the market risk from new companies that, for example, produce low carbon vehicles. And this is in climate risk terminology, market risk isn't used in the sense where we're used to using it in risk, talking about a VAR. It refers to supply and demand in the climate risk context. Another example is from the food industry. Now, it's exposed to numerous risks, such as chronic physical risk from changes to growing seasons. It also has acute and chronic physical risks from increased water scarcity that will impact operations. For example, if you're a beverage producer, you might have problems actually getting enough water to produce your product. And it also impacts suppliers, so people who actually grow crops, grow food. And there's also transition risk affecting the industry via changes to consumer demands. And these risks also in turn will impact the revenues, the expenditure, the income, and the value of the assets on their balance sheet. So this was just a couple of examples from a couple of industries. But this is really the thought process that people in financial institutions really need to start going through now and understanding, are the companies I'm investing in or lending to exposed to physical risks? Are they exposed to transition risks? How big are those risks? Do I need to help them to transition to a more sustainable operating model, or are these operating models that really will not exist in the future? So in summary, there are a lot of interrelated complex risks that now need to be considered when lending to, investing in, or insuring corporates. Now, Joe will tell you how financial institutions are dealing with those risks today.
Thanks, Maxine. Let me see if I can get to the right screen for you all. Is that the right screen? Okay,
yes.
So brilliant. Yeah, nicely done. So if you aren't convinced already, I'm not quite sure what will convince you of the need to start taking this seriously. But what we've done in GARP is we wanted to look at how financial firms are managing the financial risks from climate change already. And what I would say is that we have learned along the way quite a lot, and I think the firms are learning through this process. The firms in our survey are all anonymous, so you won't see any naming and shaming. That's not the game we're in. We are trying to build a community of firms that can learn from one another and see the range of practices and what they need to do to become leaders in climate risk management. Okay, so this, I wanted to just take you briefly through the results of our second annual climate risk survey. And this slide gives you, if you like, the structure of the questions. And what we do is we score firms along these different dimensions. The dimensions are taken from the TCFD framework. We're not scoring firms' disclosures, we're scoring them how good they are at risk management. But the structure and the building blocks of becoming good at climate risk management are encapsulated within these different blocks. So, for example, we look at governance, we look at the board engagement, and we look at how they're organised. We look at whether they are assessing the risks and opportunities, whether they're thinking about the strategy they need to adapt. We absolutely focus on how good they are at risk management and their use of metrics, targets and limits, and also their use of scenario analysis. As Maxine explained and Jonathan, Many of the most serious risks are actually going to play out in the future, and we don't know what future path we're on. And so scenario analysis is really the key tool that firms are going to have to start learning and building capability in. And we also look at how firms are disclosing, whether they're disclosing in line with TCFD or not, and the state of maturity, if you like, of their disclosures. The scale of the survey is just given in the little grey box at the bottom. This survey, we had 71 firms, 43 of them were banks, and there were 28 others. Significant scale, $42 trillion of assets on their balance sheets and $36 trillion of assets under management. As I say, it's not just banks, it's also insurance companies and financial market infrastructure and asset managers. So it's quite a spectrum. I believe it's the only survey in the world that has that kind of breadth. So let's start with governance, because in a sense it all does start with governance and the board. And what we found this year, if you look at the chart, this gives you the results from the 2019 survey in green relative to the 2020 survey in black. And we find that board engagement has strengthened further this year. Now, we tend to ask a few questions on board engagement. Not only does the board have responsibility for this, but have they actually done anything? Have they seen any papers? Have they had discussions? Because you'd be surprised how many firms will just tick, yes, the board has responsibility, but they actually haven't seen any papers. So you question the level of commitment there. And what we find in the leading firms, I've given you a few examples here, of the types of things that boards are beginning to do, like, for example, reviewing their disclosures, absolutely, but also looking at their policies towards carbon intensive sectors. Maybe they're looking at their capital frameworks as well. Many boards are beginning to bring in experts to talk to them about what they should be doing as well. Senior level responsibility is also a really important part of governance. And this chart, we didn't actually publish this, but it shows you that on the right-hand side, in terms of the key person in the C-level that has executive responsibility or accountability is typically the chief risk officer. That this is seen as a risk issue. And you'll see on the left-hand side rather, it's often, in over 50% of the firms, that responsibility is actually shared. So you find that often it's the risk and maybe the business people as well that are taking shared responsibility, because it is so broad a change that's needed, and it is so profound that you really need to bring the whole firm with you. So it's not just something that the risk professionals can tackle on their own. In the UK, the regulator has devised language around 3 different levels of maturity. So the basic level is a responsible level, and that is where it's a corporate social responsibility focus. Not to say that that's not important, but they're really focusing on reputational risk. And then you go up a gear and you can be responsive, which is a narrow, short-term focus, but they are looking at the financial risks. And then the most advanced is the strategic approach, where it's comprehensive, it's long-term, looking at the financial risks with good board engagement. And what you see in our results is that most firms want to be strategic. That's the black bars. That's what they're aiming for in the future. Now, that's partly because that's what the regulator expects. But even before that was formally announced, firms do want to, they recognise the importance of this, and they recognise the need that they're going to have to be strategic if they're going to survive. What's interesting, we've talked an awful lot about the risks here, and Jonathan did sort of hint at the opportunities as well. And there are huge opportunities in terms of the amount of investments, in terms of backing the right players as we transition to a low carbon economy. And what we found quite interesting is that in the near term, up to 5 years, the firms in our survey think that there are more climate opportunities than risks. So that's quite telling. There's obviously the risks of missing out as well. But beyond that, the risks and opportunities are sort of equally balanced. Interestingly, though, when they've looked at their strategies, they found that beyond the 5-year horizon, their strategies aren't really seen as resilient. So they know that they are going to have to change course if they're going to continue being profitable and making good business decisions. What stands in the way, though, is many different barriers and challenges. And this chart shows in the top panel their short-term concerns, that's concerns up to 5 years. And then in the bottom panel, those concerns longer term, beyond 15 years. And we've just shown you which kind of categories of concerns have low, medium, and high significance. So if you just look at the highly significant ones, the black bars in that top panel, you can see in the middle, the availability of reliable models is one of the key barriers that firms feel making it difficult for them to make real progress on managing these risks. Second is regulatory uncertainty. So it's great that we have Frank today to help us understand that pathway. The more that regulators can do to help firms understand their expectations, the better. Another one I would pick out, though, is internal alignment on climate risk strategy. It may not be the most important, but if you don't have internal alignment, if you don't have everybody pointing in the right direction or the same direction, it can be extremely difficult to make progress. And that's where I say, you know, it's not just the risk professionals here, it's also business, it's the relationship managers. Have they got the right competence to go out and have conversations with their counterparties? It's about HR, it's about your culture, it's about training. It's about legal. It's also about, of course, procurement, your buildings. It's everything. And so what we found is that the firms that create cross-disciplinary working parties to bring all parts of the business together really do, I think, have an edge on those where it's just run by a separate team, because you just can't get it embedded quickly enough. What's interesting, I think, looking longer term, those concerns do ease. And so the availability of reliable models eases back. It's still reasonably significant. But all of them, apart from regulatory uncertainty, doesn't ease that much. So I think there is a real role here for the regulator to make sure, as I say, that their expectations are clear. The survey also goes into how firms are actually organised to do their risk management. I thought I'd give you just a couple of insights here. So when you're thinking about climate risk, how will it affect your loans, your portfolios? You've got a choice. You either treat it as a principal risk or you can embed it into other risk types. And what we find is that 80% of the firms in our survey have chosen to embed climate risk within their existing risk types. And that sort of makes sense when you think about how Maxine explained how it will affect us. It will affect credit risk, it will affect operational risk. And so it really makes sense to think about that within the context of your existing risk management. Won't work for all firms, but for the majority of firms, that seems to be the emerging leading practice. Why it's so very challenging, but also so very important to start thinking about this is because for most firms, they do not believe that climate risk is priced. And I'm not surprised because we don't have available models and the data isn't necessarily there either. And there's a huge range of uncertainty as well. So it's got kind of everything going against it, if you like, from a pricing point of view. And pricing models are often not over these long time horizons as well. So we're going to have to build new models, new techniques, develop new methodologies to cope with this. But I think it shows you that, I mean, only 4% thought it was priced in. This means that there is the scope for very sharp movements in prices and asset values. As market participants become more aware of the risks and they start taking this seriously and start embedding it, I think it shows massive opportunities, but also enormous risks as well. One of the things we do with the survey is we score some of the responses and they feed into a maturity model so that we can see, if you like, how good firms are. And what we're going to show you now is the range of practices. Now, this chart actually isn't published. We published a simplified version, but this shows for the 71 firms, the scores in the different categories. So you've got firms that are literally just starting on this journey, firm number 71, who will remain anonymous, up to firm number 1, that is really has been doing this for much longer, has really got embedded. And you see, I think, in terms of the categories that are the hardest, I would say the metrics, targets and limits are hard, but scenario analysis is really difficult as well. And I think a lot of firms are really just beginning to get to grips with thinking about how to do that. So a huge range of practice. Those firms that are better have typically been doing it for longer. So I think the message is, don't be disheartened, but you do need to start thinking about this. And if I just leave you with a few kind of overall themes, if you like, there's an awful lot more information in the publication, and we'd be happy to provide more information if any of you wanted a follow-up seminar. Equally, if any of you think, oh, quite like to be in that survey next year, then do get in touch with us. But the messages we took from this year's survey was really everything starts with the board. Those firms that are good have got really good engagement from the board. And the board is needed because they need to think about the strategy. They also need to commit resources, and they need to show an interest, and they need to make sure that it's holistically embedded within the firm. I think it's interesting that firms in our survey see more opportunities than risks in the near term. Beyond that 5-year mark, firms don't think their strategies are resilient. So it's very clear that those who have started on this journey and have really thought hard about it are beginning to realise that they are going to have to change their business models, their products, their services longer term. Practically all firms think climate risk is improperly priced or not priced at all. As I said, meaningful scenario analysis is hard, but there are more resources coming out now. And if you follow this, you will know about the Network for Greening the Financial System. That's a coalition of central banks and regulators, and they have recently published frameworks for reference scenarios. So there are more resources coming out, but I think you have to just start committing some resource to this. From GARP's point of view, we are passionate about risk education, and we see an urgent need to build capability and awareness, which is partly why we're so delighted to be part of this webinar today. And so I would point to some additional resources that you can get from the GARP website. We have recently launched a Sustainability and Climate Risk Certificate, and I think it's quite telling. It's the first new product that GARP has released in 11 years. We're mainly known for the Financial Risk Manager certification. This is a certificate. It's not as quantitative. It's kind of a foundational bit of learning, but we feel that there's nothing out there really teaching you the kind of full range of things that you need to understand, from sustainability, as Jonathan was alluding to, sustainability through to climate risk. There's also various other things. The other thing I would say is we have got a climate risk symposium in November, and we can provide the details with you. The reason I flag that here is because Arthur Ewan has kindly, from the HKMA, has kindly agreed to be one of our panelists. The symposium is in November in 2 parts, and the first one we've got some regulators, Arthur, Sarah Breeden from the PRA, and Kevin Starrow from the New York Fed, and they'll be talking with some practitioners. But the second part of it is a scenario game. It's a role play where we will we'll see how it goes. It's going to be a virtual one. We will pretend that the audience is on the board of a corporate, and they will be playing a transition risk scenario and asked to vote on different things with a panel of experts to help them, guide them through this decision making. And I think that that might bring some of this to life. I personally think that you just have to look at all these opportunities out there, all of this educational material, and you need to just start. That's always been the message that Maxine and I have promoted. So do look at our website if you want more information, but I hope that's given you a nice introductory flavour of the work that we've been doing.
That's absolutely fantastic. Thank you so much, Joe and Maxine, for your very valuable insights. This is a huge topic and you've shared a wealth of information. So I'm actually very impressed you've distilled these in such a short amount of time. Thank you very much. And good afternoon, everyone. My name is Nancy. I am a director at ANZ in Sustainable Finance. We are a proud member and supporter of the Hong Kong GFA and firmly believe in leading the growth of sustainable finance in Hong Kong. Now, managing climate risk is at the heart of what we do at ANZ. Just yesterday, we successfully issued our own 1.25 billion Sustainable Development Goals bond. With over 70 diverse investors in the book, it demonstrated that right here, right now, there is strong market support for banks who put sustainability at the center of business and risk management. Now, it's a pleasure to take you through to the next stage of our presentation, including the much anticipated panel discussion. Before we dive in, let's take a quick breather and do a live poll check-in. We've got hundreds of bankers in the audience, so the results will be very representative, I believe. Can we just begin the next polling? So you've got in front of you, everyone, the set of 3 questions. I think the first is very, very interesting, especially hearing what Maxine and Joe have shared. Which area do you think has the greatest impact on your business over the next 5 years? First is losses resulting from extreme weather, losses resulting from stranded assets, losses resulting from the next pandemic after COVID-19, or D, losses due to fines imposed by regulators. So that's the first question. I think that is a really good question. There's a number of risks, as Joe and Maxine has highlighted. It will be very interesting to see what we all think. The second question is a simple one. How much help do you need in addressing these risk issues? The first one is, do you need help? The first one is yes, urgently. Second one is no, I feel well supported. And C is no, these are not important risks under my responsibility. So it could be someone else. And our third question is, what is missing from your company to take ESG to the next level? Now, we've heard from Joe and Maxine on the results of that survey. What about in your particular organization? So for A, what's missing? Is it board or management buy-in? Is it B, internal training required? C, incentives? Or D, all of the above? So we'll just have maybe a few more seconds before we reveal the results of the poll.
All right. We are
Great, I've seen half of us have voted. A lot of us are still pondering. Okay. 5 more seconds and I'll close this poll and reveal the results. Here we go. So from the first question, we can see that almost half of us think that the greatest loss will come from the next pandemic, but also followed by the impact of extreme weather events. The second question is, do you need help? Yes, urgently. That's overwhelming majority of us need help urgently. And thank you, Joe and Maxine, for showing all those resources where we can go for help, as well as obviously the Hong Kong GFA here to support the Hong Kong banking group. The third question is, what is missing from your company to take ESG to the next level? And the overwhelming majority is all of the above. So it seems like a big number of us have actually seen strong board and management buy-in, which is great. Fantastic. Thank you so much for these inputs, everyone. I will stop sharing the results and let's get started on the very meaty panel discussion. So first of all, I would like to begin with asking our very esteemed guest, Mr. Frank Leung, the Head of Banking Policy at HKMA, to share a few short remarks on the work that the Hong Kong Monetary Authority is doing. I'll then ask each of the panelists for their insights, and please to keep the responses to about 3 minutes each. Now, Frank, over to you.
Yeah, thank you, Nancy. Jonathan already in the beginning mentioned our three-phase approach to green and sustainable banking. And let me give you an update of our progress so far. Back in May, we issued a common assessment framework and asked banks to do a self-assessment of their own readiness and their progress on the green banking based on the framework. So they returned the self-assessment to us over the last 2 weeks, and we are reviewing the results. At the same time, we also issued a white paper in June to outline our initial thinking on our supervisory approach to green and sustainable banking. So our initial thoughts are based on 9 guiding principles, grouped under 4 broad categories, covering governance, strategy, risk management, and disclosure. So we will use the white paper as the basis for our further engagement with the industry. And we start off the engagement process with our participation in this webinar. So this is a brief summary of our work so far.
Fantastic, thank you so much. It's a very comprehensive set of publications as well. So I'm really interested, the first question to you, Frank, what kind of feedback have you received on the Common Assessment Framework? And really, what's most surprising to you?
Actually, we received both expected and unexpected feedbacks. And the most surprising part is actually that the feedbacks are mostly quite positive. So, you know, in our experience as a financial regulators, when we introduce new regulatory requirements, we usually would encounter resistance or some negative comments, even for international standard, for example, introduced by the Basel Committee. But this time on green and sustainable banking, most of the banks are actually quite receptive. Maybe they realize that they inevitably have to do something, or else they would fall behind their competitors, whether in terms of their corporate reputation or in terms of taking advantage of the business opportunities in the green finance space. I think this is consistent with the survey results done by GAP, as just mentioned by Joe. So this is the surprising part. For the expected parts, so banks generally express their concern about the practical difficulties in incorporating climate-related risks in their risk management process. So the typical difficulties are related to the data and knowledge gaps. So because of these difficulties, the HKMA will keep in mind and try to adopt a more inclusive and facilitative stance when we implement our supervisory requirement on the green and sustainable banking. So that's basically the major feedbacks we received. Yes.
Thank you very much, Frank. That's very helpful to hear, and it seems like it's become the tipping point where everyone realizes the importance. I really want to take this opportunity to turn to Sammy, who is from PwC and a climate and sustainability leader. You speak to many banks, Sammy. What are some of the challenges you see them facing, and in particular, getting themselves ready for responding to the regulatory requirements?
Right. Thank you for the question, Phoebe. I'm very happy to share what we observe from the day-to-day. Frank is right. Many of them feel about the excitement of the business opportunities. Some of them ask us, now we are promoting this new green product, where should we go hunt our clients? Where are they? But on the other hand, Frank is also correct, and our observation from the webinar and other interactions, the knowledge gap is the primary, hurdle or challenges. And not many people are as knowledgeable as Jonathan, the physical risk, the impact, or the scenario planning, 1.7 degree, 4 degree scenario. So those are stressful. And So I think since Ada already mentioned the challenges or the fear or the anxiety, I could share, in terms of the local banks, the medium size or the, better practices, what have they been doing in overcoming or moving on in their journey. So we saw a few banks that they start from the top. They got the board members appointed as leading the sustainability committee. So they started to formulate cross-functional team. Many of them, a few of them have clear responsibility defined so that risks are involved, also corporate banking, also HR arranging training. So that's the encouraging part. But then the other aspect that they are driving to move the momentum also include have a very realistic mindset. They feel okay to tell the regulators that they're not ready. So it's okay to respond as 0 or 1, but hey, let's get together a work plan, maybe a 3-year journey, have a realistic work plan. Let's say that we start learning TCFD from a cross-departmental basis, and then have a few key milestones so that things are not, just that let's do it tomorrow, next year, that type of mentality. A few of them got a bit more ambitious that they want to do that on a quantitative approach, which could be challenging. Also, some of the banks try a pilot approach that maybe we just start from certain business sector and we identify a few high impact industry. So there are different approaches from technical knowledge update, formulating the team, defining the responsibility. A few of them got some incentives to drive things, move things along. So we see some pretty encouraging momentum. And of course, there are quite many of them are still scratching their heads and feeling the anxiety and hoping the regulation would go away. And also a few of the quicker mover that they are, let me go hunt the clients and, these are great opportunities and I want to make it a game changing and maybe we can overcome and take a, early moving advantage move. So it's quite varied.
Oh, fantastic. Well, it's good to know that we can tell the truth and you're there to support. And I think for many of us, it's a journey and journey of learning. Thank you for sharing, Sammy.
Sure.
I just want to turn over back to Joe. Joe, you've really seen the journey of many banks managing both the physical and transition risks. And you've shared quite a lot of industry best practice, but really, what are some of the things that has been the industry best practice and arguably the European counterparts who have been a few steps ahead of Asia, for example, how have they overcome those challenges?
Thank you. Well, I think, many of them have just started. So they've been going maybe for more than 5 years now. And I wouldn't underestimate the impact of just doing this for longer. Some of them were prompted by the regulator with mandatory disclosures, for example. And that can certainly sharpen the focus, sharpen the mind when you have to tell the world how you're doing. And one thing I would say is quite interesting in the UK, the two regulators, the Prudential Regulation Authority and the Financial Conduct Authority, put together a climate financial risk forum last year. And this forum has 5 banks, 5 asset managers and 5 insurance companies. And it's a kind of industry-led but regulator-supported initiative. And they've just recently published some chapters or guides, if you like, which I would recommend the audience having a look at. Maxine and I were actually secretariat to the Scenario Analysis and Risk Management Working Group, so we sort of help put the material together, but it's industry, practitioner focused. And why it's interesting is that one of the questions I see is, can you give me an example of meaningful scenario analysis? Well, if you look at the Scenario Analysis chapter, then you will see examples from firms about how they've actually gone about doing it. And many of them are disclosed in their TCFD disclosures or sustainability reports and that sort of thing. But in terms of other things that the good firms are doing, as I said, it starts with the board. They review different aspects of their business. They tend to have a roadmap. So they're realistic about the time it will take. They try to embed it. It is very much about education at all different levels, and different types of people within the firms will need different types of education. So it's a strategic imperative, and they're the firms that are doing the best.
Sure, thanks, Joe, and it's great that we've got so many people joining us here, hearing and really improving our education on this sector. Thank you, Joe. Jonathan, you've shared a fantastic context into green and sustainable banking. I just want to turn to you for a banker's view. You've touched on some of the opportunities available. Can you just share how tackling climate change really can open up opportunities for banks, and how can it actually be good for business? Because sometimes it seems quite contrary talking about some of these risks, and how could it actually be good for a bank?
Nancy, thank you. And I wanted to pick up on a comment Joe made. I think she suggested that we'd hinted at a $100 trillion investment opportunity that needs financing to address this challenge. I think that number's often quoted, but it is just, I think if you want one single number, that just does reflect the enormous scale of this, and 70%, as I said, of that expected to happen here in Asia. So your question, Nancy, then is, I think, well, if that's out there, how do you go about sort of accessing that? And I would suggest that the real answer to that for all of us is clients, and through our clients as banks. And I think Maxine made the point very, very relevantly. Our impact on the environment through our operations is important, but it's nowhere near the scale of our impact and ability to influence through how we sort of work with our clients. And so in a sense, the opportunity side there really is to understand just exactly how are they impacted. And again, Maxine gave some great examples, and you can see from that, when you look at that, just therefore where are the investment needs to address those risks in your client's business. And then what you really want to be, and without giving away trade secrets here, is you want to be the first bank in line then to come in and deliver those solutions. And I think it's actually almost that, as a concept, it's that simple, thinking about the clients, working with them, defining their needs, and then building solutions for them. Because the interesting thing, switch between the sort of the risk side of the coin and the opportunity side of the coin, is the unique thing about climate risk, for example, is that it's embedded in our entire ecosystem on which our society is built, and then our sort of economy and financial system on that. So there's no escape from climate risk. We cannot manage climate risk entirely by just setting limits of appetite. Oh, I've got enough exposure to planet Earth, I'll take my business somewhere else. So the management of the risk actually involves taking risk. It involves doing things differently, rethinking what we do. And that's, again, I think at the core of those key client conversations that I would urge all bankers to have, because in a sense, you know, Nancy, I applaud the great work that you guys do, because if you help a client decarbonize, then I and everyone else on this call benefits. And this is the concept of these externalities. So I think for all of us, there is that opportunity. And of course we compete, but collectively we gain as well.
Absolutely. And I think we all win by your point. It's we all can gain, and really it's about going on that journey together with our customers to really, you know, educate ourselves and also understand you don't have to know everything to engage, because a lot of our experience is that clients actually love us going to them and engaging with them on this topic, even just asking, how are you tackling these physical and transition risks, and engaging with them on that topic and coming up with a solution together. So I think sometimes as bankers, we always want to have it ready to go, but it is a journey and everyone's learning. Thank you so much, Jonathan. to turn to Danny Wong, our very esteemed guest, who is the Deputy General Manager of Bank of China, Hong Kong. I really want to get some insights from Danny on how you're seeing China rise to the challenge of managing climate risks. And more importantly, how should Hong Kong do our best to position for the growth of green and sustainable banking that is to come?
Okay, Nancy, thank you. Your question. I'm honored to be here with all you to share some of my perspective. To be frank, in the past 40 years of continuous economic growth in China was successful. That is also accompanied with vast air pollution, waste, also about the water pollution and some climate effect. So we can see that China government has made a big determination and effort to how to improve this issue. It is quite obvious that we have some good signs. And also in the past 10 years, we observed that China has been very active to implement the national strategy on addressing climate change. China's government has set a clear climate risk management goal, like he signed the Paris Agreement in 2016 and promised to reduce carbon intensity 40 to 45% from 2005 levels by 2020. This goal was realized in 2018, 2 years ahead of target. Besides, it emphasized very much on energy revolution, its energy strategy. It cut coal's share of the total energy from, amazing 78% in the past, is so serious, to now it is 50-something in 2019, and promote the use of natural gas and renewable energy, and also provide incentives to support the wind and solar generation. And China really makes some good achievement in improving energy efficiency. According to IEA, International Energy Agency, China has been one of the biggest driving force behind energy efficiency gains worldwide since 2000. And also China's put great efforts to make the green economy transformation and also develop a service industry over nearly 60%, and also to promote their green transformation, to invest in the low emission infrastructure in green city plan and something. And one also key recently, you can see that China has been actively promoting green finance. It better laid the foundation of green finance. China's government released a series of documents to address related issues. You can see that Green Bond Endorsed Project Catalog is one of the important documents. It tries to, new edition 2020, unify the green bond standards and enlarge the scope of covering all types of green bond in China. And also, it takes mainstream international green finance taxonomy into consideration. And it can now exclude the frozen fuels and exclude the clean utilization of coal in the past before. So we can see that looking forward, China will also actively join and promote international cooperation. And we can see more and more good progress, because we believe that climate issue is to all people, all nations, all countries. Managing climate risk is not only the internal need to change, but also due responsibility to develop a better shared future for mankind. According to the second question about how to do a better position to do the green finance in Hong Kong, I think we admit that Hong Kong is located in a very ideal position to connect the East and the West. It acts as a very important financial gateway for China to connect the rest of the world, and also like policy like Great Bay Area, Belt and Road Initiative will bring more cooperative opportunities with Hong Kong. We have some very good driving force like government vision, Hong Kong MA regulator, Hong Kong e-exchange support, and also more and more corporate are willing to determine to be a green corporate. So I think Hong Kong will have a very good position with GBA green business, as well as the green practice to SEA. I will will give some four recommendations to be further grow our green hub. First, I think it's very important. The definition of green and sustainable are different around the world. So I think now it's no very good international standard. I think Hong Kong can put more resources to work with internationally to establish this diversified green definition and standard, allow some surely aligned with the international standard, but at the same time, allow some flexibility to accommodate the world's green demand and regulatory regime. Second, establish an international recognized green labeling scheme. It is important. Thirdly, it is building and maintaining a very important pool of green talent, professional, and then to some university and some professional body. And lastly, Hong Kong could also support the development of green and sustainable banking by developing, scaling and exporting some climate solution, mobilizing capital for sustainable projects, green projects, and supporting and engaging in international cooperation. Thank you.
Fantastic. Thank you so much, Danny. I absolutely agree with all of those points that we should be doing, and we've ended on a very high note. Thank you so much for all the speakers. We have basically bang on time for this session, and have about 5 minutes to answer the Q&A that's come through. So thank you everyone for your keen attendance and listening, and these questions that have come through. I am just going through the ones that we have received. I see 2 of them relate to the role of regulation. So Frank, I would like to direct this first question to you, which comes from Pablo. I think there should be clear incentives promoted by the regulators so that banks can benefit on directing the efforts towards ESG. But how can this happen, for example, on the carbon emissions front, if not all regulators are coordinated? So going to Danny's point about that coordination. For example, if the USA does exit the Paris Agreement. Frank, it's a tricky one, but you're here, so over to you.
Yeah, it's a tricky one because it involves the fundamental issue of the mandate of a regulator. As you know, traditionally, a regulator is about supervising banks to make sure that they manage the risk properly. So that's why when most of the European regulators, when they start to address this climate change issue, they start from a risk perspective because it is consistent with its traditional mandate. Climate risk can affect the bank's financial risk through traditional channels. And as a result, it is legitimate for us as a regulator to ask banks to do more on this front. So as for the issue of incentives, it involves a debate on whether it should be the roles of the regulator or it should be the fiscal authority's responsibility to provide incentives. What we think, our thinking on this stance is we should set aside the ideological debate at the moment and start to do the work. So we may start with the easier part or the low-hanging fruit parts. For example, we can start with asking banks to start to look at the issue from a risk perspective. Once they get knowledge and awareness on this issue, inevitably, everyone will reach a consensus that we need to do something on this. Then I think naturally over time, when banks are subject to the request of the stakeholders, they will inevitably be pressured to do more. Even if a bank, let's say they focus narrowly only on the risk side, the stakeholders would ask them, why are you not doing more on the development side, setting aside some green finance target? So this addresses the issue that even in some countries, for example, the US, they quit the Paris Agreement. My understanding is that actually a lot of the US banks, they are actually quite active in terms of setting targets for green financing. So I think that this peer pressure alone would make a long way for them to redirect more financial resources to sustainable banking activities. And at the same time, I think that even for us as a regulators, even if we solely focus on the risk perspective at the moment, we can still do a lot of foundational work that could facilitate the directing of financial resources to a greener projects. For example, some of the fundamental works like taxonomy, it's very important for us to label green products that could facilitate the market development. So our approach at the moment is to set aside the ideological debate, to start the process and build up some infrastructure to facilitate the development of green finance in Hong Kong. Thank you.
Thanks very much, Frank. I think you've hit on some of the really key notes. Then great to have you join us for this live discussion. I think we have time for one more question. Very quickly to Joe, one of the questions was to your slides. Can you show an example of a meaningful scenario analysis, please?
Yeah, as I mentioned, Nancy, the guides that came out as part of this Climate Financial Risk Forum, there's one on scenario analysis. And maybe it's possible to send a link through you to everybody to that guide. And in there, there's examples that firms have published. It's typically published material, but you can see some of the firms have done multiple scenarios looking at the impact on their portfolios. And the best firms, and in fact we found the firms are tending to do a kind of a Paris-aligned scenario and a more extreme sort of 4-degree type scenario. So it's a range of scenarios. And sometimes they don't take action on the back of it, but they're so horrified by the 4-degree one that they then start to take action on the sustainability side because they just can't believe the kind of physical impacts. So it's part of that education, you know.
Sure. Thank you so much, Joe. We will share those links around. So with that, we are right on time for closing remarks by Jonathan and Frank. So over to you, Jonathan.
Well, Nancy, thank you. And thank you for running such an excellent action-packed panel session there. And I think thank you is the word to, really to everybody who's joined to listen, and everybody who's contributed through the presentations and also the contributions at the panel. I think if there's a takeaway here from what we've heard, there's no doubt this is a massively important issue, and it's a huge challenge, and the solutions are very tough and very difficult to find. And that comment from Joe just there around scenario analysis is just an illustration of that, to actually break down an economy and an earth system and think about how the two interact and what that means for an individual institution or actor within the global economy is extraordinarily difficult. And we have lots of work to do to address that. And that's really why I would perhaps in conclusion sort of urge all of the young bankers who are listening in to think about how green and sustainable banking could really be the way that you can define a purposeful career in an industry which historically and in the not too recent past has had its challenges, but today really now is in a position where society needs our industry to step up and address these challenges. And you have the resources there. I would thoroughly recommend people engage first with the awareness and the learning and the GARP training. Go to the NGFS website and others, the Network for Greening the Financial System website, where you have some amazing papers written by the leading central banks and prudential regulators. There's a huge amount of information there to be absorbed, and then take that into your daily work, whichever team or division of the bank you're working with, whether it's with clients, whether it's with risk, whether it's setting, looking at key areas such as measurement and reporting. So engage and take that work into your daily routine, because we need to do it. And it's great to hear Frank's comments that the response to the common assessment framework really are very, very positive. And we really do have, in my opinion, we have some great people here in in Hong Kong. We have a huge capacity and capability to not only address our own system for the benefit of Hong Kong and the many of the regional markets that we support, but also on the global stage. And of course, to be able to do that, we absolutely rely on the tremendous leadership of the Monetary Authority and our regulator. So to Frank and his team, thank you very much for your support and your leadership. And perhaps I can pass to you for just a final word of encouragement or nudge as to the next steps.
So thank you, Jonathan. So for the next step, in the second half of this year, the HKMA will further engage with the industry to collect more feedback on our proposed supervisory approach in the white paper. For example, we will have further discussion in the working group we previously formed for the common assessment framework. We may have a deep dive section with some individual banks to know more about their approach. So our plan is to formally consult the industry on our supervisory requirement in the first half of next year. And at the same time, we are now doing some preparatory work for the implementation under phase 3. For example, we have already announced our pilot stress testing exercise with banks. We have also set up the cross-agency steering group with other local financial regulators to work on these taxonomy issues. So in the second half, we will also provide more capacity building activities. So the HKMA is now working in full steam on this green finance area. And even though the pandemic is here, it won't stop us on this journey, because we do see that there's an urgent need to do more on this front. Thank you.
Okay, thank you. Thank you all for dialing in, and thank you all our speakers, our presenters. And this is a great webinar, and we will be posting the recorded recording on our website. So do follow HKGFA. This is just the beginning, and we are there to help you, assist you in going through the greening and your institution. So keep follow our website and stay in touch. Everyone stay safe. Thank you. Thank you.